So the gold price had its biggest intraday loss in almost 2 years this week. Why is it doing this? And is gold still a good investment? Let's find out. After a stellar performance of late, the gold price has decided to take a bit of a breather this week and has gone through a pullback. We've been at the forefront cheering on the gold price rally. So does this mean we're wrong and it's all over? No, it just means that the gold price has experienced a pullback. We still expect to see gold touch additional highs this year. And even without any additional gains this year, investors should still hold gold in their portfolios. After all, gold is in a long-term uptrend and the fundamentals that got us here still remain. Consider this. Back in the 1970s, things weren't that dissimilar to where we are now. Inflation was high and geopolitics were fractious even then. And what happened to the gold price? It experienced some pullbacks and then it doubled. To be clear, what is going on this week is totally within the realms of what happens when something is in a long-term uptrend. When precious metals undergo the kind of gains witnessed in the past 10 weeks, sell-offs can be deep, but also short-lived. So what happened? Is this just some profit taking going on? Yes, that's exactly what's going on, plus a bit of fear. This decline is primarily thanks to futures traders who lack confidence and are facing losses. This is happening across geographies, and many of them are likely receiving margin calls from their brokers, forcing them to close their losing positions. Additionally, those who have managed to make profits are seizing the opportunity to realize them. And this is not uncommon to see. Despite this loss of bullish momentum, we remain incredibly bullish about gold's long-term performance. And therefore, this week's downturns in gold and silver should just be viewed as substantial price corrections within larger bullish trends. Futures traders buy and sell gold like that, click of a button. They do so hard and fast, and so their decisions are felt quickly and sharply, as we have seen this week. Meanwhile, those of us who invest in physical gold because we see the bigger picture are just sitting here, holding on and perhaps taking advantage of what's happened to the price. This isn't that surprising. Many commodity market experts have cautioned about the overbought market conditions resulting from gold's surge to unprecedented levels surpassing $2,400. Nevertheless, they have also emphasized that given the robust fundamentals, any potential market downturn ought to be viewed as a chance to buy. But why did those who trade gold begin to close their long positions and capitalize on the profits that they have accumulated in gold over the past month this week? Why not wait a bit longer? Well, as tensions temporarily ease in the Middle East, attention has shifted towards evaluating the US economy's resilience and the persistent presence of inflation. With the likelihood of a near-term rate cut by the Federal Reserve decreasing and optimism growing about avoiding a direct conflict between Israel and Iran, traders have taken advantage of the rising bond yields and the strengthening US dollar. So is a cut in federal interest rates just not happening now? And is that bad for gold? Well, according to CME FedWatch tool, markets see less than a 20% chance of rate cut in June, and furthermore, expectations of a rate cut in July have dropped below 50%. These shifting interest rate expectations are what are supporting higher bond yields and a stronger US dollar, and so pushing gold back somewhat. And don't forget, while the Federal Reserve isn't anticipated to decrease rates over the summer, it's improbable that they'll opt for rate hikes, and they have to. Despite persistent inflation exceeding the 2% target, they will have to proceed with lowering interest rates. And why will they? Because of escalating debt levels. Just servicing the debt makes the maintenance of higher rates unfeasible. The Bank of America estimates that US national debt is rising by $1 trillion every 100 days. Now let's say that again. $1 trillion every 100 days. And this brings us to another fundamental supporting the gold price, central bank demand. With numbers like that regarding US debt, it is no wonder that other central banks are buying gold. They do not want US dollars. They want to diversify. Gold is the third most held reserve currency, and it's the only debt-free reserve currency. So expect central bank gold purchases to remain strong this year, thus providing further support for the gold price. And why is US debt such a concern? And why do we think growing US debt won't just go away? After all, you would think that with bond yields and the US dollar, that there is nothing to worry about. Maybe we should all sell our gold. Don't be too hasty. As Ray Dalio explained in a note last week, history and logic show that when there are big risks, that the debts will either 1, not be paid back, or 2, be paid back with money of depreciated value, the debt and the money become unattractive. Since debts are promises to pay money, when a government has too much debt to be paid, its central bank is likely to print money. This prevents a big debt squeeze from happening by devaluing the money. i.e., inflation. Gold, on the other hand, is a non-debt backed form of money. It's like cash, except unlike cash and bonds, which are devalued by risks of default or inflation. Gold is supported by risks of debt defaults and inflation. So the US debt isn't getting repaid without major debasement in the US dollar, and that is why gold is still the ultimate portfolio hedge. And we can forgive it for a tumble down now and again. In conclusion, this pullback is not a sign of a change in the fundamental reasons why people invest in gold and seek to own it. Instead, you have one group who own gold as a great portfolio diversifier and safe haven, and on the other side, there's those who buy gold just to trade it. This is just about profit taking from those who have looked into the eyes of rising treasury yields and strengthening dollar and want to make a quick buck or two. So yes, the gold price has pulled back slightly. Yes, you might be feeling sore right now if you happened to buy gold last week, but believe me, this will seem like a distant memory as we get further down the line and the fundamentals that have driven gold have just continued to snowball. If you're wondering if the current price is presenting itself as a great entry point, then why not try dollar cost averaging? And what does this mean? It means spread your gold purchases out. Instead of thinking, I need to buy an ounce of gold right now, why don't you commit that $2,400, say, to gold purchases over the next 4 or even 6 months? Commit to investing $400 a month in gold. Not the whole lot now, just cost average in. Many of our clients do this. It's called the Gold Saver, and you can find out more about it below. And if you want to know why we expect the gold rally to continue, then check out this video here.